So our topic today is IRA or Roth IRA, and there's no wrong or right answer to this, just so you all know. These are just vehicles for some deductions one way or another, either now or later. The investments are a total other subject. We're just going to go through the pros and cons of why you might want to have one versus the other, or why you might want to have a combination of the two. So just some background. Traditional IRAs. Traditional IRAs have been around for quite some time, started back in the 80s. And just the basics. So on a traditional IRA, the contributions may be deductible, but they may not be deductible. Anyone can contribute to an IRA. The question is whether or not it's going to be deductible or not be deductible. Your savings grow tax deferred as long as they stay inside the IRA account. Taxes come later when you start to make distributions. Withdrawals, when you do take those distributions, are generally, depending on whether or not they were tax deductible, added to your income at the time of a withdrawal. Anytime you make money to put money into an IRA account, if you are not 59 and a half and you want to take that money out, you may be subject to an additional 10% penalty to do that. There are a few exceptions to that rule. So 2019, the contribution for an IRA is $6,000 if you are over the age of 50. There's one reason that getting older is better. You can put a little more money away. You can put $7,000 a year away by the time you file your taxes next year. I shouldn't say it, by the time April 15th rolls around of next year. You must have compensation in order to contribute to an IRA. So what I mean by compensation is it has to be earned income. It can't be, there's some passive income, so you can't use that as a way to contribute to an IRA. It has to be earned income. And you cannot be older than 70 and a half by the end of 2019 if you wish to contribute to an IRA. Once you turn 70 and a half, you can no longer contribute to a regular IRA. So Roth Basics. So let's talk about the basics on Roth. No deductions for your contribution. You just put money away. However, this one is different. Your savings grow tax deferred well inside, same as on a regular IRA. Contributions may be withdrawn at any time, any tax time penalty free. So your contributions can always come out. It's where we get into earnings that you have some problems. So you can always put money in a Roth and get that money back out. Qualified distributions include earnings and are also tax-free. So once you get past 59 and a half and you've been in there 5 years, there's some extra rules there. You can get the earnings out of a Roth IRA tax-free as well. But your contributions you can always get out. So rules. Same rule, $6,000 for this year, $7,000 if you're over the age of 50. Must have compensation, same as on the IRA. However, there's no age limit. So if you're still working at the age of 70 and a half, you can still put money into a Roth IRA. There is no exception. Income cannot exceed certain levels. So we have issues. That's part of why you have these nice little forms in front of you, is to tell you single filers can make a full Roth contribution if their income is below $122,000. Married couples can make a full Roth contribution if their income is below $193,000. So there are some rules on whether you can make a contribution or not. So spousal IRA and Roth contributions allows for a non-working spouse to be able to contribute to an IRA. So the income doesn't have to be yours if you're married. The income can be your spouse's. And that works on either IRA or Roth IRAs. So non-working spouse must meet the other qualified income applications. So if your income is still over, even if you're not working or your spouse is working, you're still not going to be able to contribute to that Roth IRA. So, we're talking about $7,000, right? It doesn't sound like a whole lot of money when you're getting ready to retire. Is that going to make a big difference? So this illustration here is putting $7,000 a year at an age of 50 for 10 years. So if we earn 6% or an average of 6% over that lifetime, what is your income or what is that asset going to be worth? At a 6% rate of return, that asset, if you leave it alone for 10 years, is going to be worth $300,000. So $7,000 does make sense if you can earn some money on it. So side effects, we have to talk about distribution. So I have a very mixed room here. I've got some young, some old. So some of you are going to be in the contribution phase or the savings phase. Some of you are going to be more talking about the distribution phase. So there's two sides of an IRA, right? Savings, and then when you finally have to start to take the money out. So side effects of IRA distributions. you can increase exposure to a net investment tax, 3.8%. That's a pretty big number to get to before you have to worry about that. There are certain phase outs. There are reasons that you cannot make a contribution to an IRA. Your income is too much. So you might have to think twice about whether or not that deduction makes sense. When you start to take your distribution, it may cause your Medicare premiums, Part B premiums, to increase. So if you take too much money out in 1 year, now you have a bigger income, Medicare premiums are based on your income. And so therefore that number can go up as well, and now you're paying more for your Medicare over and above what you would have paid for in the past. Increase the amount of taxable Social Security benefits. So if you have a regular IRA and you are taking Social Security benefits, there's a calculation that goes in to figure out how much of your Social Security is going to be taxed in retirement. So you get the pleasure of paying taxes while you were working, and you get the pleasure of paying taxes again on your Social Security when you retire. And if you're starting to take IRA distributions, it may increase the amount that you're going to pay in income tax on your Social Security benefit. So it's something we like to look at and make sure that we're planning for that to happen. It can reduce or eliminate financial aid for a child's education. So when you take a distribution, that adds to your income, correct? So now when you add to your income, that's going to mean that you probably are going to get a lower award when it comes to your child's education. And you can reduce or eliminate the Roth IRA contribution because you've paid too much money. And then, of course, there's more. So avoiding IRA withdrawals allows you to keep a protection for a long time, okay? And you keep the income off of your tax return. So you can't avoid withdrawals forever. So what happens? When you turn the magic age of 70 and a half, Uncle Sam says, guess what? I want some money. I want you to pay income tax on that money, so now you got to make a distribution, and he tells you how much. You can take more, but he's going to tell you you must take a certain percentage of that money out of that IRA and pay income tax on it. So we want to make sure that we know, are we planning along the way for those distributions so that they're not too much money to make other things taxable as well. So required minimum distributions once you turn 70. Now, if you were still working at a place of employment, your IRA you would have to take those distributions, but generally speaking, you would not have to take a distribution from your employer's plan. There are some exceptions to that, but most of the time you do not have to take one from your employer's plan if you are still working. This is the big one. Failure to take an RMD, or required minimum distribution, when you're supposed to take one, results in a 50% penalty. So if you needed to take $1,000 out of your IRA and you did not take $1,000, the penalty for that is 50% of the amount of the distribution, or $500. So calculating your required minimum distribution, okay? So Uncle Sam, like I said, gives us a chart. So he tells you that at age 70, your life expectancy in years is 27.4 years, and so on and so forth. So every year you can see that number gets bigger. So the further you live, and our life expectancies are getting longer every year, the more money you have to take from that IRA account. So here we've done it in percentages. So at 70 is 3.65, but if you look here, by the time you're 80, it's 5.35%. So it gets bigger and bigger every year. So it can be a significant number that you're going to be forced to take out. So RMD mistakes. So aggregating RMDs between different types of retirement accounts. So what do I mean by that? So you have an IRA, you have a 401k, and you have a 403b. I know those are all different types of accounts, and maybe you don't know what they all are. But each one of them are different types of accounts. You cannot aggregate them together and take one distribution from one account. You have to take the amount from each one. Now, if you have 5 IRAs, you can take it from one IRA because they are titled the same way. So if they're titled the same way, you can make a distribution from whichever account you want to make it from. If they're titled separately, you have to make that distribution from each type of titled account. Okay? Aggregating RMDs between spouses. Okay? I'd love to just take it all from my husband, I'll keep mine for myself. No, I have to take separate RMDs. You cannot aggregate them together as well. And then forgetting to take the RMD and doing nothing about it. There's always ways to catch up on things, kind of what we talked about before. So strategy number 1 is maybe we want to hold off taking them. So allowing the IRA funds to grow tax-free as long as possible, right? Might make sense. Might not need that money right now, so maybe we're going to wait till we're 70 and a half. Keeping your IRA off your income tax for as long as possible. and avoiding the side effects of the IRAs for as long as you can. That might be one strategy, right? Just keep pushing it down the road as long as we can push it down the road. Okay, this is the drawback. As it grows, so does Uncle Sam's share, right? So if your IRA is worth $10,000 this year, and by the time you're 70, it's worth $20,000, you gotta pay more money, right? You gotta pay more at that particular time because of the growth in there. So once you start doing that, what's the other question? Do any of us know what tax bracket we're gonna be in when we reach that age?
Yeah.
Okay. So right now, taxes are fairly low, correct? Maybe by all standards in the United States, they're fairly low. Do we know what they're going to be in the next few years? We know that there's a sunset provision on the taxes that we're paying right now, right? It only lasts for so long. So unless Congress makes the tax laws permanent, they're going to go back up to the way they were a couple years ago. And we don't know. We also know that right now, okay, there is House divided, right? The House and Senate are controlled by different people. If it's all controlled by one party or another, can they go in and change the rules? Even before that rule changes? Absolutely, they can. So we don't know where taxes are going to be, so that's a hard decision to make on when I should start to change it. If you want my opinion, taxes are about as low as you're ever going to see them. So the question is, are you earning a lot of money while you're working, and you believe that when you retire, you're going to be in a lower tax bracket? So far, for the most part, that hasn't worked out real well. Most people are in about the same tax bracket they were when they started saving this money. So we'll have to wait and see what that brings. Okay, IRA distributions are going to be higher, push your income tax higher. Like I said, the other issues got to do with Social Security and whether or not we're going to make Social Security benefits taxable. So understanding about Social Security benefits and how they're taxed, you can make as an individual up to $25,000. Any of your Social Security gets taxed. After you make $25,000, 50% is taxed. And then it goes up from there. It can be so that 85% of your Social Security is taxed. So if you're right on that bubble, you want to see if you can keep that from happening. Because what's the other idea? What's the other issue? Uncle Sam isn't a graduated situation there. So if you go $1 over, so let's say you're a married couple and you make $50,000, if you make $50,000 and $1, you went over. So you now are in that next bracket where more of that money counts for taxation. So we have to be very careful on how we do that. So Roth conversions. So Roth conversions are different than contributions. So conversions have to do when you're taking money from one taxable product and we're going to a non-taxable investment vehicle. So IRAs are similar, move to IRA. Tax amounts are, when you convert it, it's added to your income. So if I have a $5,000 IRA that I want to convert to a Roth, I'm going to add $5,000 to my income this year. I'm going to pay income tax on that $5,000. And maybe that's a good scenario for me. Maybe I should do that. So in this particular case, we're going to do an illustration here. She's going to convert $100,000 from her IRA to a Roth. She's going to add $100,000 to her taxes. When we're doing this, that $100,000, what do we know? Do we know if she went to the next tax bracket or not? Yes, that's the biggest question. You can do these in stages. So if you have an IRA that's worth $50,000, $100,000, you do not have to do it all in 1 year. So maybe your strategy, and we'll talk about strategies here more in just a minute, maybe you want to take $10,000 a year and convert it so that you're not going to those next tax brackets. You're not taking one big lump sum all at once and do it. So all distributions from Roth IRAs are tax and penalty free if you've had a Roth IRA for more than 5 years and you're 59 and a half. So like I said before, if you are under 59 and a half and you put money in a Roth IRA, you can always get your contribution out. What you can't do is get the earnings out, okay? Once you're 59 and a half, you can get the earnings out. Before that, you can get the actual contribution out. If you're over 59 and a half, you can convert and be distributed anytime penalty free. So maybe I am 58, and this year I know I don't have a lot of income and I want to convert because I know that sooner or later I'm going to be able to take that money out of that account without having to worry about the taxes. Maybe that makes sense for me because I know the following year and a half I'm going to not have to worry about earnings. Okay? So it's not a 5-year rule, but I'm going to get closer to that idea of where I can have a Roth IRA and not worry about the taxes. So, who can do a Roth conversion? Anybody. Anybody can do a Roth conversion. There are no age limits. there are no income limits, and there's no requirement to be working. So it's one way that you don't have all the rules that Uncle Sam puts on you and everything else. Anytime you want to make a Roth conversion, you can do that. Okay? So Roth conversions hedge against the increase in future taxes, right? That's kind of what we're thinking, is that we're going to have all these earnings come out at a lower tax bracket. Future tax rates are unknown. So if it's not taxable when you take it out, and Roth distributions do not make your Social Security taxable, might want to have Roth IRAs in retirement and not have regular IRAs in retirement. Taxes are a major concern for most of us, right? Conversion will allow you to pay the taxes today when you know what the rates are. What you don't know is whether you're paying a higher rate than what you would pay later, because are you going to be on a lower bracket? Those are the unknowns that all we can do is basically guess where we think rates are going to go. You can help manage cost tied to your income, Social Security, and Medicare like we talked before. So they have no required minimum distribution. So if part of your goal is to leave your family some money and you don't think you're going to need it, you can put the money in a Roth IRA and you're never forced to take any money out of it. So you can leave money in a Roth IRA and never take a distribution. There is one exception to that rule. If you inherit a Roth IRA, you are forced to take money out. So unfortunately, my mother passes away. I inherit her Roth IRA. The government's going to force me to take money out because they don't want it to keep growing tax-free, but I still don't have any income tax on that. But either way, I am going to be forced. That's the only time you're forced to take money out of a Roth IRA. So there's no reason that you can let it go forever and ever. Still keep growing tax-free inheritance to your beneficiaries. They can leave it in a beneficiary Roth IRA and keep it growing tax-free forever, or they can take the money out because there won't be any income tax bill. So, talk about conversion. Used to be in the old tax law that I could tell you today, let's convert $25,000 because we believe that it's going to be a good deal for you. You get your tax bill that next year and you say, oh, I can't afford to pay all those taxes. We could undo that, okay? We could go back and undo all of it or part of it at any time. Unfortunately, with the new tax law, or fortunately, however you look at it, you are now stuck. Too bad. Too bad, she said. Once you make that Roth conversion, you are stuck with it. It's kind of the way it is. So what do you want to do? What are the questions to ask yourself? Do you have a rough idea what the impact's going to be on your tax bill? All right? One of those things that you want to go and sit down with your CPA, whether you do it yourself, all the tax planning software has some what-if scenarios in it. We have what-if scenarios in our financial planning software where we can say, you know, what do we think the tax consequence is going to be if you do this Roth conversion? Do you have a plan on how you're going to pay those taxes? Are you going to take the money out of the IRA and pay those taxes? Or are you going to take the money from personal, or can you only get a refund and you're going to say, okay, I'm going to just not get as big a refund this year? Whatever the case may be, as long as you're planning for that kind of scenario. And do you have reasonable expectations that the benefits you're prepaying your taxes make sense in your overall plan? Like I said, we don't know where we're going to be down the road, but we can certainly give some thought to where we want to be, what our goals are, and why we might want to do this. So when I talked before about conversions, here's one before conversion and after conversion. So when we're doing Roth conversions, we're going to go through scenarios and say, okay, now with the new tax law, we have these different buckets, right? So we have a 0% tax bracket, a 10% tax bracket, a 12, and a 22. Do we want to fill up any of those buckets? We probably don't want to get to the 24, the 32, the 35, unless we believe that's the tax bracket we're going to be in for the rest of our life. But we may want to fill up the 10% bracket. We may want to fill up the 12% bracket so that we never get to those bigger numbers. The older we get, the more we're going to be forced to take out of that IRA. So maybe earlier, we want to take a little bit every year to keep that number from being too low later on. So this is the scenario behind that thought, is to say, okay, can I fill up that bracket? Maybe it's only a couple $1,000 that fills up that bracket. Maybe it's $10,000. But we would look at that scenario to say down the road I'm then going to have tax-free income. So bigger Roth conversions in years with usually low income may be the best. So maybe for some reason this year you just started a new job. So you didn't work all year. So is this the year to do that? You know, next year you're going to work all year. So let's say your salary is $40,000. This year it's only $20,000. Do you want to take and convert $10,000 this year because you know that next year that would make your income $50,000 versus $40,000. So those kind of scenarios, in the years in which you think your income is going to be lower. There are some other things, business owners. There's some things to play with or think about here, okay? If you had an unusually slow year, do you have a tax loss that we may want to think about that may allow us to do this conversion and you're not going to pay any income tax or very little income tax on that? Maybe you have a lot of medical bills that you can actually deduct. Now that they've made that much more difficult, that's a little bit harder to do because that's a pretty big number to get over. But after retirement and before receiving Social Security benefits. So you don't want to make those Social Security benefits taxable, right? You've worked on them, you've earned them, so do you really want to make them taxable? Maybe those years between 60 if you're retired and when you've decided to turn on Social Security, maybe that's the best time to make those conversions before the Social Security kicks in and it's going to become taxable. Maybe it's always going to be taxable for you, so that doesn't matter, but it is something to give thought to. So potential limitations and risk. There's no guarantee that the Roth conversion is going to achieve the intended result, right? We don't know where taxes are going to be, so is it going to achieve our result or not? There's no guarantee that the Roth distribution rules won't be changed. The IRA rules have changed several times. The Roth is relatively new. It wasn't born the same time the IRA was. So do we know? We know right now one of the conversations in Congress to raise more taxes is to eliminate the stretch distribution. We'll see if that happens or not. Right now, if you inherit an IRA, you can stretch that over your lifetime. But there are people that believe that maybe that the 5-year rule should come back to play, and all the longer you're going to have is 5 years to get rid of that IRA. So we don't know. Those are the kind of things that we just don't know. Can you afford to have it added to your income? Is it going to affect distributions, the same distributions, kind of like the taxation on other things, if you take that Roth conversion? And then there's no guarantee that the investments inside the Roth. So like I said, we didn't talk about investments at all. Investments can have a big deal. What investments are better in an IRA versus a Roth IRA? Do you want the income producing ones in the Roth because you're not going to pay income tax on them? Do you want the fast growers? Do you want the bank stocks, the Googles, the whatever in there so that can grow and you're never going to pay income tax on it? That's kind of a scenario you have to sit with somebody and say, okay, what are my goals and what makes the most sense? So we're here to help and answer all these questions. Making a decision about whether or not it's a Roth or whether or not it's a regular IRA is a big decision. There's no right or wrong answer here. It's what's right or wrong for you. I remind people all the time what's good for you may not be good for your brother, may not be good for your sister, and most certainly probably is not good for your neighbor that has 5 kids and 2 ex-wives.